Time is a very powerful variable when it comes to your financial life. So it's actually more than your income, even more powerful than your investment picks, and more powerful than market timing. So here's the paradox that nobody lays out really clearly enough for folks is that number one, time is your greatest asset, but with that said, number two is you're actively running out of it. So it's both a blessing and a curse. Okay. Now, both of these things are true at the same time. So let me show you exactly what I mean by that. Okay. Now, if we look at this bar chart here, okay, we have some assumptions built in. So we're assuming someone's saving $500 a month, and we're using a 7% average annual return here, okay? But across this, we're looking at different starting ages. So we're looking at the same contribution amount, the same return, all right? The only variable is when you start. So the only variable here is time, okay? Now, if someone starts at age 25, all right, and we have this number, the chart, it's going out to age 65, okay? So someone starting at age 25 is saving that $500 a month at 7% average return. They're going to end up with a little over 1.3 million. So it's 1,310,000. Okay. Now, if that same person started at age 35, they would end up with 607,000 at age 65. And then if they waited even later and they started at age 45, all right, they would end up with 262,000, okay? So the gap between starting at 25 versus age 35 is 703,000. Okay, so that's from one decade, all right? Now break that down and it's roughly $192 every single day you're sitting on the sideline, okay? So just a quick note here, these figures you're seeing, they're hypothetical illustrations and they're based on just assumed inputs that I put in there so that I could depict this message. But so just understand they're not representative of any actual investment results, okay? And the assumed returns are not guaranteed. The results will vary. They could be higher or they could be lower, okay? And also, we're also assuming a $500 a month um, savings rate. Okay. Now, here's a concept really everybody should know or should at least understand, and it's the rule of 72. Okay. And if you're unfamiliar with the rule, what you do is you divide 72 by your expected return, and that tells you roughly how long it takes for your money to double. Okay. All right. Now at 7%, okay, the money doubles roughly every 10 years. Okay. All right. Exactly. If it was 7.2%, if you took 72 and you divide it by 7.2%, that's where you'd get uh, an answer of 10. Okay. So roughly at 7%, the money doubles every 10 years. All right. So a 35-year-old with $100,000 invested gets three doublings by 65 if they're getting a 7% return. Okay. All right. So that means they'll end up with $800,000. All right. Now, 45-year-old with that same 100,000, they're only going to get two doublings. Okay. So that means they're going to end up with 400,000. All right. All right. If we're using the rule of 72 here. Okay. So you didn't just lose 10 years, you lost 10 years of potentially doubling your money. Okay. Now, here's where it gets real. Okay. Let's say you're 38, you're 42, 45, you know you're behind, and the instinct is to compensate by saving more aggressively. So let's see what that actually buys you. So let's say you start at 40, all right, and now you double down. So instead of $500 a month, you're saving $1,000 a month at that 7%. Okay. Now, by 65, you're going to have around $810,000. Okay. All right. So you double the contribution, but it still didn't close the gap. Okay. All right, if you go back and you understand the math there. All right. So that's the point. The contribution size is really a lever you can pull. Time is the engine that drives everything. Okay. You can't out contribute a 15-year head start. That's something I often say to folks, right? You can't out save a late start and you can't out invest a late start. Okay. And that's really the important message I'm trying to get across here. Right now, add the layer most people skip entirely, and that's inflation. Okay. So let's say it just 3% annually. That 1.3 million the 23-year-old built up has roughly 630,000 in real purchasing power by the time they access it 40 years later, okay? Or 40 years from now when they go to access that 1.3 million, okay? So the target is never just a number, okay? It's really a strategy built to outpace what things actually cost in the future, all right? I'll talk about that more in future videos of how inflation comes into play. But right now, what the message is that to go back is that really you can't outsave or outinvest a late start. It's important to get started early because time really is your greatest asset, but it is a depleting asset. Okay. So now again, you're not going to outthink time. There's really no shortcut around math compounding. So the people who reach financial independence aren't always the ones who earn the most. Okay, they're actually the ones who started earliest and stayed consistent the longest. Okay, so the challenge for most people watching this might not be knowledge; it's actually just execution. Okay, because life is busy. All right, things keep getting pushed back. This might be something that keeps getting pushed back. And the math gets worse every year it sits on the burner. In fact, every month, every day it sits on the back burner, the math gets worse. Okay. So if you're in your 30s or your 40s, you're earning well, and you want a system in place so none of this falls through the cracks, you want an accountability partner. That's exactly who I work with. So you don't have to figure out the optimal allocation or the right account structure, even tax strategy. You don't have to make this overly complex. Okay. The contribution sequencing and getting started, that's the job. Your job is just to start and let time or whatever time you have left work for you. All right. As hard as possible. Okay. Um, so if you would like to set up a 20-minute virtual with me directly, I'll have a link in the description below. You can also head over to zenfp.com. Just a straightforward conversation about where you are and where you're trying to go. But with that said, I'll see you next time, folks.